Hello, and welcome to another episode of Readings in Impact Investing, the show that features important readings in the world of impact investing, sustainable finance, development finance, and ESG through the medium of audio. This podcast is a non-profit initiative made available as a public good, and its ongoing operation is supported by community donations. Find the podcast online at readingsinimpact.org or on your favourite podcast platform. Now here's your host, Daniel Rosehill.
Hello friends and subscribers, welcome back to another episode of Readings in Impact Investing. This is Daniel Rosehill, and this is a podcast that intends to take textual material in the world of impact investing and read it so that you can listen to it rather than read it. That's the whole idea, guys. The website, the podcast can be found at readingsinimpact.org. That goes out onto all the different podcasting locations. And you can also get this on YouTube. It duplicates the episodes, essentially. So if you prefer to not bother with all these podcasting gizmos and apps, you can just put your YouTube video on background play and listen and learn as you do other things through multitasking. So today I'm going to read a document from Houlihan Lokey about, and it's called An Introduction to Sustainability Linked Loans. I'm just trying to tick all the boxes to get this podcast going, because we've talked about sustainable bonds and we've talked about sustainability linked bonds. And there are also sustainability-linked loans, SLLs. If I'm not mistaken, their issuance is actually a lot bigger than bonds, but they seem to attract less attention, despite the fact that they are also extremely relevant. So I found this resource looking for something substantive, talking about the topic. I did yesterday see some report from Reuters that came out in November 2023 that I'll just mention because it came up again in my keyword search. The Reuters piece says loans linked to ESG face overhaul by under pressure banks. They're talking about SLLs. They're calling them loans linked to ESG. I'm just going to read a bit of this article from Reuters. Corporate loans whose costs are linked to environmental, social, and governance goals are being redesigned by banks. SLLs, sustainability linked loans, were first used in 2017, and they offer slightly cheaper borrowing, typically around 2.5 to 10 basis points less if companies meet goals like cutting carbon emissions or improving board diversity. So that's very, very important that it is typically 2.5 to 10 basis points. Just to remind folks who aren't aware, a basis point is 1/10 of a percentage. So 10 basis points would be 1% cheaper. And so that's just kind of giving a ballpark for where they are. And they also gave the figure for SLLs. Here it is. Amid increasing regulatory scrutiny and suggestions that SLLs enable companies to inflate their green credentials, aka greenwashing, LSEG data shows that issuance has slumped by 36% to $310 billion so far in 2023 from $480 billion in 2022. So sustainability linked loans, and they have a nice graph here, and I'm just going to describe it. This comes from LSEG, which is London Stock Exchange Group, showing that in 2019, SLLs were under the 100 billion mark. 2020 was kind of the same, well, they just above 100, and then an explosion, absolute explosion, was 2021. That was when these really kicked off, or above 400, and again 2022 was bigger, and 2023 year to date. Now obviously the year end of year figures I presume aren't in because we've just started 2024, but once those Q4, even when Q4 is tallied, it looks like they're going to drop, but I'll be interested to see that. So anyway, just wanted to refer to that Reuters piece to give some context as to where issuance actually stands. So let's now read from this document from Houlihan Lokey, and we might learn some things about the SLL market and the process, hopefully. Sustainability-linked loans are a relatively recent phenomenon but have become a topic of discussion from Wall Street to Main Street. With many organizations now required to report on sustainability, companies and lenders are also looking for ways to enhance both their financial and reputational position with investors and customers by capitalizing on the current focus on ESG issues. SLLs are loans where a portion of the interest rate margin is linked to the borrower's ability to meet predetermined sustainability performance targets called SPTs. Since the first issuance 6 years ago, the market for SLLs has grown exponentially from $4.8 billion in 2017 to $447.3 billion in 2002. So if you look at those, so we look just at the 2021 figures, but if you go further back in time, it's an even more dramatic mushrooming. So let me just repeat those figures. That's crazy. 4.8 billion of SLLs in 2017, and by 2022, 447.3. So basically not too short of a 100-fold increase in the space of 5 years. So that is pretty dramatic as mushroomings go. In its infancy, SLLs were issued in the syndicated loan market and concentrated mainly in the utility sector, consistent with green energy financing among European countries. However, in recent years, there has been an expansion of this financing vehicle to the North American private credit market and into other industries, including chemical, energy, industrials, transportation, and logistics. Oil and gas majors have also sought to issue sustainability-linked instruments, with Royal Dutch Shell in 2019 issuing one of the largest SLLs to date, tying interest and fees paid on a $10 billion revolving credit facility to its progress against a short-term net carbon footprint intensity target. Since the pandemic, there has been an increase in the number of companies utilizing SLLs as a financing vehicle, and this trend is expected to continue into the foreseeable future, given the sizable dry powder available from private funds, such as Blackstone Credit Sustainable Resources platform, which sees an opportunity to invest $100 billion in energy transition and climate change solutions over the next 10 years. I just want to emphasize again that because I just keep getting drawn back to that $447 billion number for 2022. So obviously $500 billion is 500 billion. And it looks like 2023 issuance is slowing down a bit, but we didn't come that far from $500 billion worth of SLLs in 2022, which seems to be when the market has reached its peak to date. Energy transition presents a significant upside opportunity for the use of SLLs. The International Energy Agency estimates that annual clean energy investment worldwide will need to more than triple by 2030 to around $40 trillion to reach net zero emissions by 2050. How do SLLs work? SLLs contain a feature whereby the borrower's performance for predetermined metrics is measured against certain external SPTs, with that performance triggering certain outcomes. SPTs measure improvements in the borrower's sustainability performance that are generally tied to the interest rate margin on the loan. SPTs can be 1. Internal and bespoke to the borrower's business, 2. External and set against the borrower's ESG performance in relation to its peers as determined by an external reviewers, or 3. A combination of both. Basic characteristics of SLLs include the following. There are no restrictions on the use of proceeds from an SLL. So just to interject with the comment here, that is the same as SLBs. We've talked before about the difference between an SLB and a sustainable bond, or a green bond, or a climate bond, or whatever, or that those are use of proceeds bonds, which means that the borrower is committed to using that money for that purpose. SLBs, the point's been made that they encourage sustainable performance, but they don't tie the borrower to using the proceeds in a certain way, which can be freeing for them, and they can even be used for debt reservicing. And we're seeing in SLLs, it's the same situation. They're not use of proceeds loans. The terms of an SLL, usually the interest rate, will vary depending on the performance of the borrower's business relative to predefined SPTs. The relevant metrics and SPTs, which should apply over the life of the loan, are negotiated and set between the borrower and the lenders. underscoring the collaboration process across stakeholders in the SLL structuring process. Typically, there will be no other adverse contractual consequences, e.g. breach of covenant, event of default, etc., if an issuer or borrower fails to achieve its SPTs. The only direct consequence of meeting or failing to meet SPTs or to deliver an SPT certificate is an adjustment to the interest rate margin. The type and level of the relevant SPT selected usually depends on the sector and business model of the borrower, but should be ambitious, measurable, and aligned with the borrower's long-term sustainable strategy. And that is also something we're seeing in the world of SLBs, whereby it's emphasized that in the best practices, like the best practices advanced by the ICMA, the International Capital Markets Association, and I presume they have a guidance document for SLLs as well. I'm almost certain they do. They underscore that the sustainability targets are supposed to be ambitious and not business as usual, right? You're not supposed to just say, or tokenistic. And that is, I think, where the concern about greenwashing comes in, that folks are alleging that these are being used for borrowers to make very tokenistic objectives and thereby capitalize on cheaper debt. And they look good and they give themselves a pat on the back, but they haven't actually achieved all that much. So this is something that people in the for those of us who want to avoid greenwashing and impact washing, which is everyone in the sustainable finance space, we have to be diligent and vigilant against that possibility. KPIs include reduction of greenhouse gas emissions, utilization of renewable energy, water quality, use of recycled materials, percentage of women into senior management, employee training and diversity, anti-harassment culture, workplace safety standards, and provision of education and food waste, among many others. Process roadmap for SLL issuance. Firstly, there is the selection of KPIs. KPIs must be relevant to the borrower's business and aligned with the sustainability strategy. KPIs must be measurable or quantifiable on a consistent basis and be able to be benchmarked to assess the ambition of the ESG goal associated with the loan. These are actually the sustainability-linked loan principles, acronym SLLP, which were developed by a working group from the Loan Market Association and Loan Syndications and Trading Association, who set out a framework for issuing SLLs that enable market participants to understand the characteristics of a SLL. And so this is just replicating the 5 components. So we've already talked about selection of KPIs. Next, we have calibration of SPTs. The calibration of the SPTs per KPI is key to structuring SLLs, since it sets the level of ambition the borrower commits to. It is recommended that an annual SPT should be set per KPI for each year of the loan term and be determined on a predetermined timeline set before or concurrently with the origination of the loan. Just to reiterate, an SPT is a sustainable performance target. SPTs should represent a material improvement in the KPIs and be beyond both a business as usual trajectory and regulatory required targets. Borrowers may seek input from an external party via a pre-signing second-party opinion that reassesses, among other things, the robustness and reliability of selected KPIs, the rationale and level of ambition of their proposed SPTs, and the relevance and reliability of selected benchmarks and baselines. Then we have reporting. Borrowers must report at least annually to the lender on their progress towards reaching the SPTs. The two parties must also decide whether the SPTs are still relevant and ambitious. Information relating to the SPTs will often be included in a borrower's integrated annual return of sustainability report. However, a borrower may choose to share privately with the lenders rather than making this publicly available. Loan characteristics and economic benefit should be provided if the borrower meets the predetermined SPT. For example, the interest rate margin will often be reduced if the borrower satisfies a predetermined SPT as measured by the predetermined KPIs and vice versa. Finally, verification. The borrower's performance for each SPT and KPI must be independently reviewed by an external party at least annually. SLLs by the numbers. The total dollar value of SLLs issued between 2017 and 2022 experienced a CAGR of 143.4%, while the US market specifically achieved a CAGR of 128.8% between 2018 and 2022. Globally, the total number of SLL deals increased from 15 in 2017 to 895 by the end of 2022. So that's good to know that the number of SLLs, and again highlighting 2022 as the year of major issuance, was less than 1,000. So, I mean, look, it's obviously a very fast-growing market, but still we have yet to cross the 1,000 barrier, and it seems to me unlikely that will have been crossed in 2023. Given those numbers reported in the Reuters piece that opened this podcast. We note, however, that the volume of SLLs issued for the year-to-date period ended June 30, 2023 has declined precipitously as compared to the prior year, which is consistent with decline in the wider global debt market. New issue volume in the global debt market for the year-to-date period ended June 30, 2023 is down 51%. The global debt market has been less active in the first half of 2023 as a result of tightening credit conditions, rising debt costs, and a more selective lender base. Despite the decline in SLLs, a recovery in the wider debt market should also result in a rebound in SLL issuances. And we have again the total SLLs issued globally from really a standing start in 2017 of 4.8 billion through to that big figure in 2021 of 476, and then total SLL deals globally, 15 in 2017, 2022 we got up to 895. So the SLL market in the US, in 2018, CMS Energy issued the first SLL in the US, consisting of 1.4 billion worth of new credit facilities with renewable energy generation as the SPT. So that's a historical point. The first SLL in the US was energy generation as the SPT, and then total SLL deals in the US. We can see sort of something quite similar to the international trend. Then they have a page called Benefits of SLLs. SLLs are an alternative to traditional capital raising that provides benefits to both corporate borrowers and lenders. Innovative financial instrument. The concept of SLL started gaining traction around 6 years ago, so market participants in this nascent debt instrument may be viewed as forward-thinking and potentially attract a diversified investor base. Interest rates are linked to agreed sustainability performance targets, which allow borrowers to align financing sources with their wider sustainability plan. Lenders could benefit from a new revenue stream and develop a competitive advantage, particularly for funds focused on energy transition. Different credit investment strategies. The versatility of SLLs has resulted in the instruments expanding from the syndicated bank loan market to the private credit market, offering new investment strategies to private credit funds. Increasing appetite across energy and infrastructure credit investments, SLLs provide an opportunity for investors to make bespoke interventions in a portfolio company's sustainability strategy without taking a control position. And any type of loan financing can be used as an SLL. There's also no requirement for proceeds use. SLLs are agnostic as to loan purpose, as we mentioned, unlike green bonds, which mandate the use of proceeds to predetermined sustainability projects. Funding can be used for business expansion, loan refinancing, or any other corporate purpose. SLLs are accessible to companies operating in sectors which are traditionally not considered to be green. Accomplishment of sustainability objectives. SLLs incentivize companies to improve their sustainability while realizing tangible savings from lower interest costs. The issuance of SLLs demonstrates to stakeholders that the borrower is committed to sustainability targets and helps to reinforce alignment across segments for business leaders. SLLs enable lenders to leverage their capital and resources to strengthen business and support the lender's sustainability initiatives. SLLs can play a key role in helping companies transition energy sources in alignment with their broader global energy transition. Interest rate savings linked to the ESG targets attract borrowers to consider an SLL. Now we have selected recent SLL issuances in the energy and infrastructure sector. And this document is available online from it's hl.com is the website. And you can find here an interesting little page. Actually, it's 2 pages, which is showing some recent SLL issuances. I'll just give 1 or 2 of them because it's not really kind of something that I don't think reading all of them. But if you just want to know who's doing the issuance and what sector, what are the SPTs, this could be helpful. So we have just the borrower here is Xylem. The date announced was the 3rd, these are American formatted dates, so that would be the 1st of March. Xylem is in water technology. They issued an SLL for 1,000 million, so 1 billion. The SPT was reduction in GHG emissions, percentage of global sustainable supply chain spend. The actual interest rate was SOFR plus 1.125%, and the interest rate adjustment for the achievement or lack of achievement of the SPTs was plus or minus 0.33 basis points. Then we have also in power generation, we have Consumers Energy. This was a $250 million SLL. SPTs were related to renewable energy generation and total energy. The interest rate was SOFR plus 0.85%, and the interest rate adjustment was 2.5 to 5 basis points. So this was a higher penalty or reward compared to the Xylem issuance. Again, as I said, I don't think that repeating the rest of them would be helpful. If you do want to get in touch with the team at HL, there is a contact here for Robert Teigman and Hugh Nelson. Their email address and phone numbers are both listed there. So if you're looking at issuing an SLL in the US, these guys could help you out with that process. But for those of us more interested generally in learning about the SLL as an instrument, I think this is a helpful report. And thank you for listening. This brings to a conclusion this episode of Readings in Impact Investing. If you have a report that you think would be helpful for me to read or is insightful, then please do consider getting in touch. It's public@danielrosehill.com is the email. Thank you a lot for listening, and until the next episode.
Thanks for listening to another episode of Readings in Impact Investing, presented by Daniel Rosehill. If you enjoyed this episode, then why not share it with a friend or colleague? And consider leaving a review or rating to help spread the word. Don't forget to subscribe via readingsiниmpact.org or find the show on your favourite podcast platform. Thanks for listening, and we'll see you next time.